Welcome back to Trader DNA, the home of next level trading breakthroughs. In last week's video, I showed you something that could literally change the way you trade forever. How to set your EMA indicators with laser precision, so almost every signal they generate becomes shockingly accurate. That video alone is worth millions in trading value if you actually apply it. And if you've watched it, I'm confident you now have a rock solid understanding of how the exponential moving average really works. But that's not all. I also walked you through how to combine 2 or even 3 different EMA lines to completely eliminate guesswork. No more confusion, no more hesitation. You now know exactly when the market is bouncing off support, when it's continuing the trend, and just as importantly, when it's starting to reverse. That's powerful. And it didn't stop there. I showed you how to supercharge your entries by using the CCI and MACD indicators together, so you could pinpoint those high probability entry zones with sniper level accuracy. But in today's video, we're taking it even further. Today, I'm going to show you how to use the RSI and stochastic oscillator like never before, not just to confirm the trend, but to zero in on the strongest trending conditions and identify the perfect moment to enter a trade with ultra low risk and massive reward potential. I'm talking risk-reward ratios of 1:5, even 1:10, and it's not only possible, it's actually simple once you understand how. We're going to walk through it all step by step. We'll start with the foundation. Yes, that's right, the moving average. And then we're going to build up from there until you have a fully functional, high probability trading system that you can use on Forex, crypto, stocks, or whatever market you love most. So grab your coffee, close all those distractions, and get ready, because what you're about to learn could be the breakthrough you've been waiting for. Let's get into it. Finding the perfect EMA setting, the foundation of your strategy. Okay, traders, listen up, because what I'm about to tell you is one of the biggest secrets to dominating the market. And shockingly, barely anyone talks about it. I'm talking about choosing the perfect EMA setting. Yes, the exponential moving average. Now, if you don't get this part right, your whole strategy could fall apart before you even enter a trade. But if you do get it right, boom, everything clicks. It's the difference between random trades and real, repeatable success. Now, I know EMA might sound a little technical, but here's what it really is. It's just a line on your chart that shows you the direction of the market's momentum. But not just any line. This one's smart, it's smooth, it filters out noise, it lets you see what's really happening beneath the surface. But here's the catch, it only works if you choose the right period for it. That's where most traders mess up. So how do we figure it out? Simple, we test, we observe, we let the chart tell us the truth. Watch how price behaves around different EMA settings. Does it bounce off cleanly? Does it hug the line like it's glued to it? If price respects that EMA like a trampoline or a barrier, congratulations, that's your perfect. That's the setting that aligns with the psychology of the market you're analysing. Let me break it down for you. We test the 20 EMA, then 34, then 50, then 75, then 100. Keep going. 150, 200, one by one. We're not rushing, we're watching, we're learning. Until one EMA starts to stand out, giving clean rejections, consistent reactions, strong signals. In our case study, it was the 100 period EMA. And let me tell you, the price respected that line like royalty. Over and over again, price bounced off it perfectly. That was our confirmation. But here's the twist that most beginners miss. Just because 100 EMA works on this chart in this time frame doesn't mean it'll work on every chart. Different markets, different behavior, different time frames, different rhythm. That's why there's no such thing as a one-size-fits-all EMA. You've got to customize, you've got to adapt, you've got to be intentional. And here's the bottom line. If you don't test, if you just randomly pick an EMA setting because some random influencer told you to, you're not trading, you're gambling. But if you do test and find the one the market truly respects, you're stepping into the mindset of a professional analyst. And that's how you start winning consistently. So remember, setting your EMA isn't just technical, it's strategic. It's the first building block of a high accuracy trading system. Get this right and everything that comes next becomes easier, clearer, and more profitable. But hold on, this isn't just any ordinary moving average lesson. Nope, we're going big. We're talking about multiple moving averages. And once you understand how they work together, you're going to feel like you've just unlocked the cheat codes to the market. I'm serious. This is the kind of stuff that turns beginners into beasts. Now, I know what you're thinking. Wait, which moving average should I use? 10, 20, 50, 100? Everybody seems to have a different answer, right? But here's the truth. After you learn this trick, you'll never need to ask that again. Ever. Because you'll know how to figure it out on your own based on what the market is doing right now. And that, my friends, is how you stop guessing and start making decisions like a real trader. Let's pull up this chart. Boom, check it out. You see these three moving average lines? Yeah, right there. Blue, red, and yellow. Each one of these lines is like a force field. I'm not joking, the price doesn't just walk past them like they're nothing. No, it hits them, pauses, reverses, even explodes in the opposite direction. It's like the market sees those lines and goes, whoa, gotta respect that. Now zoom in on this. Here's the 50-period EMA. Why 50? Not because it's some magical number from the heavens. It just works in this specific market and time frame. And that's the secret. The number isn't what matters, it's how the price behaves around it. That's what separates pros from amateurs. Look at this move right here. Price drops, bam, hits the 50 EMA, and boing, it bounces up like it hit a trampoline. And again, another drop, another bounce. It's like clockwork. The 50 EMA becomes this invisible launch pad, price touches it, and boom, liftoff. So what does this mean for you? Here's the golden nugget. When you see price coming down toward that 50 EMA and you notice it's done it before and bounced, you don't sit there guessing. You get ready to take action. Why? Because you're not gambling. You're trading based on something the market has already proven to respect. And that is the difference between random trades and smart ones. This is the big idea. The moving average isn't just a line on the screen, it's a tool, it's a signal. It's like having a built-in radar system that tells you when something important is happening. And if you can master it like we're doing right now, you'll start making trades with real confidence. You won't feel lost, you'll feel in control. So lock this into your mind. Moving averages are not just lines, they are your edge. Use them right and the market starts to make a lot more sense. We already talked about the 50 EMA, your first line of defense. But now, we're stepping up our game with the 110 period EMA. Just look at the chart. I mean, look at it. Every single time the price drops and taps the 110 EMA, boom, it doesn't fall through. It launches back up like it just hit a spring-loaded floor. Right here, bounce. Over here, bounce again. And again, right there, another bounce. It's like the market is saying, okay, you got past the 50, but you're not getting past this one without a fight. So what does that mean for you? It means the 110 EMA is your backup shield, your second safety net. Like in a video game, if your first armor breaks, the second one still gives you a shot to survive and strike back. So anytime the 50 EMA breaks, your eyes immediately shift to the 110. Why? Because that's where smart traders look for the next bounce. It's the market's plan B. And here's where it gets even more epic. This chart isn't just respecting one line, it's respecting two major levels, the 50 and the 110. That's not random, that's structure, that's order, that's the market literally giving us multiple high probability entry points on a silver platter. It's like having two layers of confirmation before jumping into a trade, and that makes your decisions way stronger. But wait, we're not done yet. This is the part where we bring out the final boss, the big dog, the 250 EMA. Yep, not the basic 200 EMA that everyone and their cat talks about. We're talking 250. Why? Because it's not about guessing or copying what others say. It's about testing. It's about proof. It's about using what actually works on this chart, on this time frame. So here's what happens. Price drops below the 110 EMA, and guess where it goes? Straight down to the 250 EMA, and boom, another bounce. Right here, price hits it, instant reaction. It's like the market slams the brakes and says, no further, this is the edge. It's the market's final support zone, the point where momentum either recovers or completely flips. So if you're writing this down, here's the cheat code. If price breaks the 50 EMA, focus on the 110 EMA. If the 110 EMA breaks, shift to the 250 EMA. And if the 250 EMA breaks, warning, that could mean the entire uptrend is done and a bearish trend might be starting. See how clean that is? No messy indicators, no wild theories that only work in textbooks. This is visual, it's logical, and it's backed by price behavior that you can see with your own eyes. And here's the best part. Once you understand how to test and find the right EMAs for your own chart, you're not just learning a trick, you're building a custom trading system. You can literally program this into a robot, an expert advisor, or an alert system. So your strategy runs 24/7, even when you're out with friends, even when you're sleeping. Guys, this isn't just some random setup. This is a full-blown, battle-tested blueprint, and you've got the power to tweak it, improve it, and own it. So here's what you never forget. The EMAs 50, 110, 250, they're not magic. You are the magic. Because once you understand how to read how price respects those lines, you can adapt them to any chart, any market, any time. And if you've made it this far, give yourself a pat on the back. Seriously, you now understand more about market structure than most traders ever will. Let's keep this momentum going because we're just getting started. How to combine EMA, RSI, and stochastic oscillator for high probability trading. Alright guys, now we're turning up the heat and getting into something seriously epic. The EMA plus RSI plus stochastic oscillator combo. This setup, it's like the Avengers of trading indicators. Each one is powerful on its own, but together they form a strategy so sharp, so precise, it can literally transform the way you trade. Especially if you're tired of guessing and finally want clarity and confidence every time you click that buy or sell button. But hey, before we dive in, I really hope you understood everything I showed you earlier about how to find the most accurate EMA settings, because that part is key. If you skipped it, go back and rewatch, because we're about to build on that foundation like never before. Okay, here's the deal. When you combine the EMA, the RSI, and the stochastic oscillator, you get a superpowered strategy that gives you not one, not two, but 4 insane advantages that most traders never even realize they can have. Advantage number 1, it tells you the direction of the trend. Advantage 2, it shows you high probability bounce zones. Advantage number 3, it tells you if the trend is still strong or about to die. Advantage number 4, it helps you time your entry with laser precision. When these 3 indicators line up, you're not just hoping for a good trade, you're catching the market when it's at its sweetest spot. That's when professional traders strike, and now, so can you. This strategy is 100% mechanical. That means it's completely objective. No emotions, no I think it's going to go up nonsense. It's pure data, pure rules, pure logic. And that's why you can literally plug this into a trading robot or expert advisor and let it trade for you. Yep, even while you're asleep or out getting pizza. And listen closely, this part is so important. No matter what strategy you use, whether it's price action, order blocks, candlestick patterns, Fibonacci levels, chart formations, even Ichimoku clouds or moving averages, whatever it is, it has to be free from emotion and personal bias. The second your feelings get involved, you're no longer trading, you're guessing. And guessing is not a strategy, it's gambling. So you've got a decision to make. You've already seen how the EMA plus 𝗙𝗂𝗪-MACD combo works in last week's video, and now you're discovering the power of EMA-RSI-STOCHASTIC in this one. Which one will you choose? That's the beauty of it. Both are powerful, both are rule-based, and both are 100% automatable. The key is picking the one that fits your style and sticking to the rules like a robot. This is how pros trade. This is how you can trade. Alright guys, it's time to dive into advantage number 1, figuring out the direction of the trend. And trust me, if you get this part wrong, everything else falls apart. But once you get it right, you're setting yourself up for monster wins. Now check this out. In this example chart, we can clearly see that the market is in an uptrend. And I mean super clearly. How? Simple. We're using our 3 custom EMA lines. The 25 period EMA, the 75 period EMA, and the 140 period EMA. And just look at them. They're all sloping upward, not sideways, not flat, not random, upward. And the price? It's riding above all three lines like a rocket ship cruising above the clouds. That, my friend, is a classic bullish trend. And guess what? That's exactly what we want to see. Because when all three EMAs are lined up like this, with the short term on top, medium in the middle and long term on the bottom, and prices staying above them, boom! You've got visual confirmation that the trend is strong, healthy, and climbing higher. But hold up. Now flip the script. Let's say you're looking at a different chart, and this time price is hanging below all three EMAs. The 25 EMA? Sloping down. The 75 EMA also sloping down. And yep, the 140 EMA too. What does that tell us? We're not in Kansas anymore. This is a downtrend, baby. The market is bearish, and it's not just a little dip, it's heading south in full force. So why does this matter so much? Because this is the very first thing you need to get right before making any trading decision. If you try to buy in a downtrend or sell in an uptrend, you're fighting the current, and that's how traders lose money fast. It's like trying to swim upstream in a tsunami. You might survive, but you're not going far. So here's what you do. Before anything else, analyze the trend. Take a few seconds to look at your EMAs. Are they lined up cleanly? Are they sloping clearly up or down? Is price respecting those lines or just slicing through them like butter? These are the clues that tell you whether a trend is really happening or if the market is just going sideways and waiting to trap you. And listen, you only want to trade when the market is trending. Why? Because that's where the high probability setups live. That's where your trades have the best chance to explode in your favour. That's where the big money is made, not in random choppy noise, but in smooth, strong, powerful trends. So write this down and burn it into your brain. Step 1 in this strategy is simple. Identify the trend. If price is above and EMAs are sloping up, you're in a bullish market. If price is below and EMAs are sloping down, it's bearish. No guessing, no emotions, just visual proof on the chart. And once you've confirmed the trend, then and only then do we move on to the next step. You ready? Let's go. All right, guys, it's time for Advantage 2 spotting high probability bounce zones when the trend pulls back. And this is where trading gets seriously exciting, because now you're not just watching the market, you're predicting where it's going to move before it happens. Like a trading ninja. So here's the deal. When a market is trending, it doesn't just move in a straight line forever. It breathes. It pulls back. It takes little breaks before continuing its run. And this is where most new traders get wrecked. They think the trend is over just because price goes the other way for a bit. But guess what? With our EMA setup, we can see exactly where those pullbacks are likely to bounce, and we get ready to strike when the time is right. Let's look at this example. This chart is in a clear bearish trend, and we're using our three secret weapons, the 25 EMA, the 75 EMA, and the 140 EMA. Price is moving down overall, but every once in a while, it pulls back up, and here's where it gets juicy. First bounce, price starts climbing, gets close to the 20-25 EMA, the red line, and boom, just like we expected, it hits the line and bam, bounces straight back down to continue the bearish trend. That's the market respecting the first layer of resistance. Second bounce. Now price pulls back again, but this time it pushes a little harder. It breaks above the 25 EMA and you're like, whoa, is the downtrend over? Not yet, because now we shift our eyes to the next defense, the 75 EMA and the 140 EMA. And guess what? As soon as price reaches that zone, boom, it reverses again and drops like a rock. The downtrend lives on. Third bounce. Now price pulls up once more, this time heading right back toward the 25 EMA, and we already know the pattern. If the trend is still intact and we're still in bearish territory, then there's a high chance the price will bounce again. And guess what? That's exactly what happens. Price hits the 25 EMA and just like clockwork, it rejects, flips and dives back into the trend. Fourth bounce. But wait, plot twist. Price starts climbing again and breaks above the 25 EMA. No worries, we've seen this before. What do? We wait for price to test the 75 EMA. And boom, right on cue, price hits that line and gets rejected hard. The trend continues, that's 2 for 2. Fifth test. Now here's where it gets really interesting. Price climbs again, this time breaking above both the 25 and the 75 EMAs. Most beginners would panic and think the trend is done, but not you. You're calm, you're focused, because you know the 140 EMA is your final checkpoint, and sure enough, price reaches the 140 EMA, and guess what happens? Yup, another bounce. Price crashes down, continuing the bearish move. Textbook. Final move, and then one more time, price pulls up, and once again it bounces exactly at one of the EMA lines and continues the bearish trend. This isn't luck, this is structure. This is the market telling you exactly where it plans to turn. So what's the big takeaway here? It's that these three EMA levels, 25, 75 and 140, act like tripwires. When the market pulls back, it doesn't do it randomly. It reacts to these invisible lines like they're walls made of steel. And when you know where those lines are and you know how to read them, you gain a massive edge over almost every other trader. This is why we don't just jump into the market blindly. We wait, we observe, we let the price come to our level. And when the market shows signs of rejection at an EMA line, that's our cue. That's where you strike. That's where high probability trades are born. So burn this into your mind. When the trend pulls back, don't freak out, don't panic. Just follow the EMA Road Map. First, check the 25. If that breaks, watch the 75. If that breaks, the 140 is your final barrier. Every bounce is a potential winning entry with low risk and huge reward. And that is the power of knowing where the bounce zones are. This is how we trade like pros, with precision, patience, and a plan. All right, listen up, because this part right here could literally save your entire trading account from blowing up. I'm not even joking. This is where we make sense of everything we've just learned. So get ready, because this is your cheat code for reading the market like a pro. Here's what you need to lock into your brain. If price breaks above or below the 25 EMA, don't panic. That doesn't mean the trend is over. It just means the market is breathing, taking a quick pullback. So what do? You watch the 75 in like a hawk. That's your second line of defense. If price reaches that level and bounces, trend continues, you're good to go. But let's say price breaks through the 75 EMA. Does that mean it's time to exit everything and run for the hills? Nope, because you've still got your 140 EMA. This one is like the final barrier. If the price bounces here, the trend is still alive. It's not dead yet. And that bounce, that could be your last golden opportunity to enter before the big move continues. But, and this is a big but, if price blows past the 140 EMA with no bounce, no hesitation, just slices through it like it's not even there, then that's your warning siren. That's the market telling you, hey buddy, something's changed. The uptrend could be over and we might be flipping into a full-on bearish reversal. That's when you step back, reanalyze, and don't fight the new direction. And let's be real, this is so much easier than those crazy, overcomplicated trading systems people try to sell you. You don't need 14 indicators, 5 oscillators, a Fibonacci calculator, and a PhD in chaos theory. All you need is this. Clean, simple, visual price beat, and a few powerful EMAs that do the heavy lifting for you. This isn't just some random trick or a one-off tip. This is an actual trading blueprint. Something you can repeat over and over again across different markets, timeframes, even currencies, commodities, crypto, you name it. It's all about recognizing patterns and reacting with confidence, not fear. And don't forget, the numbers we're using, 25, 75 and 140, they're not magic, they're not lucky, they're not sacred, they're just the results of actual testing and observation. In your charts, you might find slightly different numbers work better, and that's awesome, because the real power here isn't the numbers themselves. It's your skill to read the chart and adjust based on what the market is actually doing. That's how real traders think. That's how you should think. Flexible, focused, fearless. And if you've made it this far, seriously, give yourself a massive high five, because you're already ahead of 90% of traders who just follow random signals and pray it works out. But you're learning the rules. You're building a foundation. You're becoming a chart reading machine. So don't stop now. We're just getting warmed up. The next advantage is coming. All right, guys, let's jump into advantage number 3. knowing whether the trend is still strong, even when the market is pulling back or correcting. Because listen, just because price goes against the trend for a moment doesn't mean the entire trend is dead. Nope. It could just be taking a break, and your job is to figure out if that break is temporary or if the whole thing is about to reverse. And here's where most beginner traders mess up. They see the price pulling back, they freak out, and they either panic sell too early or jump in too soon. But not you, because after this, you'll know exactly how to read the trend's strength and enter the market like a sniper with confidence. So what tool do we use for this? It's called the RSI, the Relative Strength Index. And this little indicator, it's like your trend detector. It tells you whether the market is still running strong or starting to run out of steam. It's simple, it's visual, and it's powerful. Now, a lot of traders use the default RSI setting of 14, but in this strategy, we're doing something way smarter. We're using the 75 period RSI. Why 75? Because it matches the middle EMA in our setup. We're using 25, 75 and 140 period EMAs, and the 75 EMA is our core foundation for the trend. So syncing the RSI to that period gives us a crystal clear signal that matches the market rhythm we're already tracking. Now, here's how we use it, and I promise it's ridiculously easy. If the RSI line is above level 50, that tells us the trend is still bullish. Even if price is dipping, the overall energy is still pushing upward. The bulls still have the power, so you can confidently look for long entries during the correction. If the RSI line drops below level 50, that means we're likely in a bearish trend, and if price pulls upward, that's your moment to get ready for a potential sell because the bears are still in control. And that line, level 50, is your battlefield. It's the neutral zone. It's the difference between fighting with the trend or getting crushed by it. You don't need complicated math. You don't need 10 extra indicators. Just check. Is the RSI above 50 or below 50? Boom. That's it. And what makes this even cooler is how it works with your EMAs, because when price pulls back and touches one of your EMA lines, whether it's the 25, 75 or 140, and at the same time, the RSI is still above 50 for bullish or below 50 for bearish, that's your green light. That's your confirmation. That's when the trend says, I'm still strong. Let's go. So here's the golden combo. Price bounces off an EMA line plus RSI above or below 50, depending on the trend, equals high accuracy entry point. It's like having two filters working together. One shows you the structure, the EMAs, and the other shows you the strength, the RSI. Together, they give you sniper level precision. And the best part, this system is 100% objective. No guessing, no gut feelings, no emotional trading, just clean logic, clean charts, and smart timing. That's how professionals trade, and now you're doing it too. You ready to learn how to combine RSI and EMAs like a beast? Let's go! Because we're about to bring it all together in the next section. Alright guys, buckle up, because now we're diving into Advantage 4, and this one is a total game changer. How to find the perfect moment to enter the market with insanely low risk and massive reward potential. I'm talking sniper level precision, the kind of entry that makes you go, wait, did I just catch the exact top or bottom? And yes, with this strategy, you absolutely can. Now, let me be super clear. Timing your entry is one of the most important parts of trading. Like seriously, you could get the trend right, the direction right, even the market right. But if your entry is off by just a little, boom, you get stopped out, lose confidence, and the market runs without you. Not fun. So here's the million-dollar question. What tool gives us that laser-accurate entry point with minimal risk and maximum reward? Introducing the stochastic oscillator, the secret weapon of this strategy. But wait, before you start slapping it on your chart, you need to understand this loud and clear. The stochastic only works when the conditions are right. And what are those conditions? The trend must already be confirmed using our 3 custom EMAs, 25, 75 and 140. The strength of the trend must be validated using the RSI with the 75 period setting. If those two things aren't aligned, then forget it. The stochastic alone won't help you. It'll just spit out false signals and confuse the heck out of you. But if the EMAs and RSI both confirm the trend is alive and strong, that's when we unlock the full power of the stochastic oscillator. So here's how we set it up. We're using the classic stochastic settings, the 14-3-3. Nothing fancy, nothing complicated. Why? Because we want our signal to be globally visible. This is important. If you use weird settings no one else uses, your signals might look cool to you, but nobody else in the market sees them. But when you use standard settings, you're seeing the same entry zones that millions of traders around the world are watching. And that's how momentum builds. Now let's break it down like a pro. We use level 80 as the overbought zone and level 20 as the oversold zone. When the stochastic lines enter the overbought zone above 80 during a bearish trend, we start watching for a sell entry. When they enter the oversold zone below 20 during a bullish trend, we watch for a buy entry. But here's the twist. We don't enter just because the stochastic touches those levels. We enter only when the EMAs confirm the trend direction, the RSI confirms the trend strength, and the stochastic gives us an early signal from the oversold or overbought zones. When all three of those align, boom! That's your golden setup. That's your moment to strike. That's when you get the lowest possible risk with the highest possible reward. The kind of entry that professional traders dream about. And what makes this even more awesome is that you can get in before everyone else sees the move. Because the stochastic gives you an early warning, not a late confirmation. That means you place a tighter stop loss and catch a bigger move. And you know what? I'm going to prove it to you. You're going to see exactly how the stochastic oscillator, when combined with the EMA strategy and the RSI filter, creates a triple layered sniper system that can boost your accuracy like crazy. So don't go anywhere, the chart proof is coming up next. Alright guys, this is where everything we've learned so far finally comes together on a real chart, and I'm about to walk you through it step by step like we're defusing a bomb in an action movie. Let's go. So look at this. Right here, the market's in a bearish trend, but suddenly price starts pushing up, almost like it's trying to fight back. And boom, it touches the 25-period EMA, which, as we already learned, is the first line of defense in our EMA strategy. Now, here's the big question. Should we sell now? Should we wait? Is this bounce going to be huge or just a little dip? Here's how we figure it out. We call in the RSI and the stochastic oscillator to give us backup. First, we check the RSI and it's still below the 50 level. Perfect. That means the overall market trend is still bearish. But we're not done yet. Next, we check the stochastic oscillator and bam, we notice something super important. The stochastic hasn't even reached the overbought zone. That's right. Even though price touched the EMA and bounced, the oscillator didn't show us that the market was overextended yet. And that right there is a red flag. It's like the market is saying, yeah, we're correcting, but don't expect a big drop just yet. So what do? If you're really eager to take the trade, which let's be honest, we all get that FOMO sometimes, you play it safe. You use a tight risk-reward ratio like 1 to 1.5 or 1-2 max. That way, even if the trade only goes a short distance before turning back, your potential reward still justifies the risk. But now things get even more exciting. Look here, the price makes another move up, and this time it doesn't just touch the 25 EMA, it climbs all the way to the 75 EMA and even the 140 EMA. This is huge. So we check the RSI again, and guess what? It's still below level 50. That means even though price looks like it's exploding upward, the market is still technically in a bearish trend. That's our green light to keep watching for a possible sell. And now the big reveal, we look at the stochastic oscillator and boom, the lines are deep inside the overbought zone. And then bam, they cross downward. This is the moment we've been waiting for. This right here is what we call a high probability, low risk entry point. When that cross happens, after price hits the 140 EMA and the RSI still says bearish, that's when you hit that sell button like a pro. Now, where should you place your stop loss? Easy, right above the 140 EMA. Because if price blasts through that line, it probably means the bears just lost the battle and the bulls are taking over. So no drama, you just get out and reassess. But if the price respects that EMA and drops, you're riding a wave that could give you a massive reward with tiny risk. That's how smart traders win. But we're not done. Look right here. The market goes up again and taps the 25 EMA. Now some traders might panic. Oh no, it's going up again. But wait, check the RSI. It's still chilling way below the neutral 50 line. That's a huge signal that the trend is still bearish. So what do? You stay in the trade, you trust the plan. And one more time, we double check the stochastic. This time, it didn't even make it to the overbought zone before turning down. So yeah, technically it's a sell signal, but it's not the ultra clean textbook setup we're really hunting for. So maybe you don't go full position here, or maybe you skip it and wait for the next golden setup. The point is this: when the EMAs, the RSI and the stochastic oscillator all line up, it's like a perfect storm of confirmation. That's when you strike with full confidence. That's when you take entries with tiny risk and massive upside. And that's how professional traders build consistency. So now you've seen it in action, the full system working together like a well-oiled machine. And once you master this, you'll never look at indicators the same way again. This isn't guesswork. This is mechanical, data-driven and emotionally bulletproof trading, and you just learned it all. Everything I used in this video? The EMA settings, the RSI level, the stochastic oscillator settings, I've packed it all into one ready-to-use template file. It's linked right now in the description below. Just download it, load it onto your chart, and bam, the full setup is there, ready to rock. No guesswork, no wasting time, just pure trading firepower. And hey, if this blew your mind even just a little, do me a favor, hit that subscribe button, smash the notification bell so you never miss a new strategy drop, and share this video with your friends, your trading group, your boss, your barista, anyone who needs to stop losing and start winning in the market. You guys are the real MVPs. Thanks so much for watching,